Two Barclays analysts. One hot topic. All sides explored. This is The Flip Side. The Flip Side is a podcast series featuring lively debate between two Barclays research analysts, taking opposing viewpoints on timely topics of importance to economies and businesses around the globe.
Welcome to The Flip Side. My name is Jeff Meli. I'm the head of research at Barclays, and I'm joined today by Marc Giannoni, our chief U.S. economist. Thanks for joining me, Marc.
Thank you for having me, Jeff.
All right, today we're going to discuss how much credit we should give the U.S. Federal Reserve for engineering a decline in inflation without causing a recession here in the U.S. Now remember, when the Federal Reserve first started hiking interest rates, most economists, including us here at Barclays, were forecasting a recession. About the best scenario anyone could conceive of was what we called a soft landing, which was when activity would slow, not quite enough to cause a recession, but by just enough to cause a decline in inflation. But we have actually done even better than that.
Indeed, the U.S. economy is very strong and continues to grow above its long-run rate, at least so far. Yet inflation has fallen dramatically from its peak. It's not quite back to target, and the Fed may have its work cut out for it going forward, more so than most investors believe. But I think the Fed deserves a lot of credit for taming inflation while keeping the economy moving forward.
Well, Marc, I disagree. I think the economy is evolving around the Fed and that interest rates are largely a sideshow. This decline in inflation that we've enjoyed was pre-baked. Once markets and the economy normalized after COVID, this was what was going to happen. It just took longer than we were expecting, but the process was going to happen regardless of what the Fed did with interest rates. Now, I'm not saying that these hikes were a mistake. Instead, what I'm saying is that monetary policy just isn't this all-powerful force driving the economy the way that we have been trained to believe.
Well, let's step back. It's worth summarizing the state of the U.S. economy. We can't overstate the strength of the U.S. economy. This has been really, truly remarkable. Inflation has declined substantially. It peaked at over 9% in the summer of 2022. And in January of this year, CPI inflation was at 3.1%. PCE inflation, the Fed's preferred measure, was even lower at 2.4% year over year. It's not yet at the 2% target, but the situation is obviously much improved. And not only did we not have a recession, the U.S. economy remains above trend, with GDP growth above 3% in the fourth quarter and likely just a bit slower in the first quarter of this year. And we keep adding over 200,000 jobs per month. Indeed, in January, we added over 350,000 jobs, and the unemployment rate remains below 4%, and wage growth remains elevated.
Yeah, on top of that, asset prices are high and rising. The equity market's at all-time highs. The fixed income market has recovered from the initial shock of higher rates. Housing prices are elevated. It really feels like Goldilocks from a macro perspective. And that's just the time when everyone starts trying to take credit for this great economy.
Well, I'll take the first step, but just before we give kudos for controlling inflation, I would like to note that the surge in inflation did not happen in a vacuum. Monetary policy was too accommodating for too long in the aftermath of COVID. It acted as a multiplier on the huge fiscal stimulus supplied by the federal government. And remember that in September 2020, the FOMC had committed to keeping interest rates at zero until inflation would be at 2%, expected to be above 2%, and the labor market was at full employment. And the Fed was too slow or too late in seeing that the labor market was overheating. So it only started raising rates in March 2022.
Now, of course, once the Fed realized the situation, it acted very rapidly. The Fed funds rate went from 0% to 5% at the fastest pace that we've experienced since 1980, so over 40 years since we've seen interest rates rise that quickly. The pace and the magnitude were so severe that most forecasters were expecting a recession. But it actually never happened.
Well, I think this is where the Fed does get some credit for using monetary policy to cap inflation expectations. When the Fed was increasing its policy rate by 75 basis points for 4 consecutive meetings in 2022, and Powell made clear that the Fed's overarching focus was to bring inflation back down to 2%. This was clearly designed to keep inflation expectations anchored at 2%. Here I'm talking about expectations of market participants, of forecasters, of households, of all business leaders, everybody that sets prices.
Now, we track expectations very closely for inflation. It's actually different than other macroeconomic variables. We don't track expectations of unemployment rates or expectations of growth, but we don't track those because they don't tend to become self-fulfilling. Inflation has this odd, sort of partly psychological component to it, which is that if you expect a certain level of inflation, you behave accordingly, and it makes that level of inflation a self-fulfilling prophecy. And so we do watch this expectations issue very closely.
Yes, that's right. I think these inflation expectations and this self-fulfilling prophecy depend a lot on what monetary policy does. Most of our models attribute a very important role to inflation expectations in determining inflation, and the policy regime is a key determinant of how these inflation are being determined. In fact, what is remarkable is that even when the CPI inflation surged above 9% in 22, inflation expectation remained anchored at around 2%. In other words, people remain confident that the surge in inflation would eventually recede. This is very different from the high inflation episodes of the late 1970s and early 80s, when inflation expectation increased a lot, which eventually forced the Fed to raise rates to nearly 20%, to the point of causing a very severe recession.
So, Marc, my objection to this view is that it's utterly ex post reasoning. Not one official forecaster said going into the hiking cycle that the goal for the Fed would be to hike just enough to control expectations and not to damage economic activity. Even the Fed itself wasn't saying that. The path from interest rate hikes to lower inflation always went through slower activity in the economy and a weaker labor market. They were not designed to micromanage the path of expectations and call it job well done.
Well, the Fed obsesses about inflation expectations.
Sure, in steady state. But once inflation actually surged, the view was that the economy actually had to slow in order for inflation to get back to target. Maybe containing expectations was like part of the solution, but the bigger part was going to be slower growth and higher unemployment.
Well, I wouldn't say quite the bigger part, but you're right that Powell made very clear many times that there would be likely cost of reducing inflation in the form of reduced growth, softer labor market conditions, as well as some pain for households and businesses. So not surprisingly, as people saw rates continuing to surge and the Fed showing determination to bring inflation down despite the cost, forecasters, including us and many others, view it as quite likely that the Fed would cause a recession in 2023. I believe that the expectations that inflation would come down and the economy would enter in a recession had themselves a moderating effect on inflation and activity. So if you're a business leader, again, in a cyclical industry and you expect a recession, you might think twice about increasing your margin or starting new equipment investments.
I struggle with that, Marc. If businesses and consumers were expecting a recession, shouldn't they have spent less money, done less investing? Wouldn't we then have seen activity slow and the labor market soften? I don't think the effects of lower activity like that would be limited to inflation. It seems to me like we're cherry-picking one measure of economic activity, inflation, and saying that's where the rates had an effect, and trying to explain away the fact that they didn't have an effect on any of the other measures of economic activity that are usually very correlated.
Yes, but the economy is propelled by significant tailwind. Consumers are flush. They have benefited from very generous fiscal transfers, an increase in wealth, and significant income growth given by the tight labor market. On top of that, fiscal spending and incentives provided by the Inflation Reduction Act, the CHIPS Act, and so on are also stimulating demand. So I think of the U.S. economy like a cyclist riding down the hill. The tailwinds that we just mentioned are like a steep slope on the hill, causing the cyclist to go very fast. And monetary policy is like the brakes on the bike. So policies pressing the brakes to slow the cyclist down and improve stability. If we are looking at the cyclist quickly passing by, we may think that the brakes don't work, even if they work just as well as usual. In other words, it's not because we see the economy continuing to grow rapidly that monetary policy doesn't work. It may just be a reflection of this very strong tailwind.
All right, well, I think that's a very good analogy, Marc. But you still need to explain why inflation fell, but other measures of economic activity have not moderated.
Well, it's not true that the other measures did not moderate, or at least that none of the measures moderated. The labor market has cooled, for example. Job openings have come down from 12 million, remember, 2 years ago, to 9 million last December. And firms' hiring rate have normalized. Also, quits rate have come down below pre-pandemic levels, suggesting that workers are no longer very confident that they can get another higher-paying job elsewhere. As a result of the gradual easing in labor market conditions, and wage growth has moderated over the past year, labor costs are thus increasing more moderately than in past years. Just like inflation is above target, but below its peak now.
Well, some of this, Marc, is just, again, the COVID shock sort of normalizing. So workers left the labor force during COVID. They're re-entering the labor force now. That was bound to take some of the steam out of the labor market. Keep in mind as well that we've experienced a surge in immigration in the U.S., and that's increasing unemployment. So another sort of interpretation of this could be that even with the increased number of workers, both re-entering the workforce and new migrants into the country, we're still experiencing a tight labor market. In other words, we've absorbed all of that and unemployment still isn't going up. That makes me struggle even more to see the effect of a record-setting pace of interest rate hikes. It seems to me like you're proposing a new channel that we've never seen before, which is that you can have monetary policy reduce inflation, but without any appreciable economic pain along any of the other metrics that we usually look at.
Well, I would say it slightly differently. Given the structure and momentum of the U.S. economy at present, the large fiscal deficits that the U.S. is running and the level of inflation would have been substantially higher had the Fed not raised rates as much as it has.
All right, I'm going to give a different narrative. And my telling, monetary policy has had no appreciable impact on inflation. So let's recall that the initial impact on inflation came from COVID and the disruption that it imposed on supply chains. We were all stuck at home, desperate to buy more goods, and yet the system, the economic system globally, couldn't deliver those goods, and so we saw a huge surge in goods inflation.
Yeah, that's a very apt description of the evolution of inflation in goods prices. But it's only part of the story. As inflation fear receded, the demand for services such as dining, travels, entertainment, hospitality, all of that came back and inflation in services started rising. And that increase in services inflation was also associated with rising wages. So unlike the goods price inflation, the supply was not suffering from material shortages and supply chain disruption. Instead, that supply of services was suffering because of labor shortages, as several million had left the workforce.
All right, fine. So services inflation occurred at a different time than goods inflation, but I would argue it was still linked to COVID and the supply of labor in the market. But remember what we said about inflation back then.
Yeah, of course I remember. We thought it was transitory, meaning that these shocks would fade and inflation would fall back in line, which didn't happen. Inflation remained stubbornly high, forcing the Fed's hand.
Yeah, except I think the transitory narrative was actually correct. It was right all along. This inflation impulse was destined to fade. Sure, as you suggested, it took longer to fade than we expected. Maybe because the sequencing between goods and services was out of sync. Maybe because there were other things happening in the global economy, like Russia's invasion of Ukraine, for example, and the effect that had temporarily on energy prices. But really, none of these are permanent shifts. These are just lagged responses to the COVID impulse, which was destined to slowly but surely dissipate.
Okay, but let me ask you this. And you don't believe that the massive increase in rates is helping that process along?
I don't. And I'm going to give you a macro and a micro example of why not. First, at the macro level, there are two big structural issues that limit the effect of higher interest rates on the economy. The first is that despite this surge in goods spending that we all experienced in the initial months of COVID, the United States economy is primarily a services economy. 70% of GDP is linked to services, and services are just naturally less rate sensitive than goods are. Remember that this is not the first time we've been confused about the efficacy of monetary policy. Pre-COVID, we had almost the mirror image scenario. I had unemployment very low, inflation well below target, interest rates pegged at zero, and the Fed couldn't get inflation up. We called it misinflation at the time.
Well, that was atypical, and I attribute it to the financial crisis, which tend to lead to slow recoveries, especially because policy rate was constrained by the zero lower bound as well. We have a lot of history about financial crises and their impact on activity. But the shock of COVID restored the economy or brought the economy back to a more normal environment. And so I do not expect us to return to this zero interest rate, zero inflation or low inflation equilibrium again for quite a while.
Well, look, I think the crisis point is a good one, Marc. But at the big picture level, I would say that it's been well over a decade since we've seen monetary policy have the expected effect on the economy. And we kind of can explain it with this and that, different explanations in different periods, but we're still left with the conclusion that monetary policy isn't doing what we expect it to do. Regardless, the other big structural issue that I think is worth mentioning is that there was a huge amount of debt taken out during the COVID period when interest rates were pegged at very low rates. That debt was taken out by both households and businesses, some of which is very long dated.
Yes, we've all heard about the mortgage lock-in effect. People refinance where mortgage rates were very low, and now that they are much higher, people don't want to move. And there was a wave of corporate issuance as well in the COVID period.
Yeah, and those borrowers could care less what the Fed funds rate is. They're locked in. They're not going to pay that interest rate no matter what. So if no one's actually paying these higher rates, Why would we expect them to matter?
Well, first, higher mortgage rates discourage new marginal buyers from buying a home. And for those who financed at a lower rate, the debt matures, people need to move for all sorts of reasons. Some of the debt is also floating, particularly for companies and in the high-yield market. And those companies pay higher rates immediately. But sure, this might delay the effects of rates. But remember, we say the lags of monetary policy are long and variable. It doesn't mean that they have no effect.
All right, well, here's my micro reason why rates are not having the expected effect. Even the housing market didn't slow in response to the record pace of Fed hikes. If higher rates don't cause problems in the housing market, which is about as rate sensitive as you get, why would we expect it to have an effect on the economy as a whole?
It's fair to say that the housing market did not respond very strongly to the rate hikes. Housing data did show some slowing. In 22, when the Fed raised rates and mortgage rates doubled, home sales and housing starts fell sharply. We also had a structural issue with too few homes available to meet the demand and a large shadow demand for housing.
Okay, well, I agree with the shadow demand point. So we have structurally underbuilt homes in the United States for a very extended period, basically since the global financial crisis and the housing bubble burst. Part of that's because of restrictive zoning. Some of it might be sort of a hangover associated with like losses that builders took around that time. So yes, there are some structural factors behind the resilience of housing. And maybe that helps explain why the weakness in housing that you cited lasted like 6 to 9 months, right? And then the housing market was back on its feet again. But my larger point is that these structural issues that we're talking about are dominating the effect of rates. So rates went up, you normally expect to see housing suffer. Housing doesn't suffer because of the shadow demand that you're talking about. It's clearly that these other issues are trumping the level of rates.
That's right. And we haven't even mentioned the biggest structural issue of all, I guess, the massive deficit. That's also a big driver of the economy. So there is no question that this deficit is very large. It reached 7.5% of GDP in the fiscal year 23. This is particularly notable given the strength of the economy. And it serves as a tailwind as well. The effect of that tailwind can be seen also in the international comparison, for instance. Rates went up in Europe and in the US, and inflation came down in both. But Europe has not had the fiscal stimulus that we've had, and its growth is significantly slower.
Yeah, in fact, Europe's basically flirting with a recession.
That's right. And in contrast, the US activity accelerated in the second half of last year. But this is notable that the main difference is not on the inflation front. It's more on the growth front. The higher rates have likely helped restrain some of the stimulative impact of fiscal policy.
I want to turn to a last driver of the economy, the wealth effect. So the wealth effect means when consumers get richer, they spend more. That supports growth. When they get poorer, they spend less and growth slows. Now, when interest rates rise, you usually see wealth go down. This is actually an important channel through which monetary policy affects the economy.
Well, wealth or asset prices are part of a broader financial conditions and the transmission of monetary policy as well. When central banks lower rates or buy assets, say via quantitative easing, for instance, to support the economy, they tend to raise prices of other assets, thus increasing wealth and spending.
Yeah, but here's the problem. Other than that 6 to 9 month period that we just referenced in 2022 when housing market fell, we're totally missing this channel. In fact, if anything, it's going in the opposite direction. Equity prices are at all-time highs. The fixed income market's recovered. Housing prices are back to being elevated. The wealth effects are positive. They're not negative. So once again, we're just not seeing the expected effect of rates.
I agree that the increase in wealth since the pandemic constitutes an important fundamental driver of consumption and aggregate demand, along with also solid income growth. This is one of the reasons that monetary policy needs to remain restrictive and that the Fed is not yet confident that inflation is sustainably coming down to 2%. That said, there are some signs of activity being impaired. Look at the IPO market, for example. It's still very slow.
All right, well, let's turn to the future, Marc. Given the momentum of the economy, I have to admit that I'm a bit confused about the expectations out there that the Fed is going to start cutting interest rates. I think that the main drivers of the economy are structural. It's the big deficits, the wealth effect on consumers. And the interest rates have not dampened that, and they won't. And given that, I think the economy is going to maintain its momentum. If it maintains its momentum, the Fed is going to have a hard time cutting interest rates because the fundamental strength of the economy will persist.
Well, I think monetary policy is slightly restrictive now. I don't think it's extremely restrictive, but it is slightly restrictive. And with that, we expect activity to gradually slow coming this year. We expect inflation to gradually come down, and that would allow the Fed to start cutting rates. We don't expect that to happen anytime soon, but maybe sometimes around the summer, we expect the Fed could start really cutting rates if the economy has slowed.
All right, well, we'll obviously be tracking this very carefully over the next several months. Clients of Barclays can follow our latest take on the path of interest rates and the level of the economic activity in the Global Economics Weekly, available on Barclays Live.
That's all for now from this Barclays podcast. Thanks for listening, and we'll catch you next time on The Flip Side. For more insights on this topic, clients can log into Barclays Live or find out more at barclays.com/CIB.